you with us today. Another day to be alive. And so that is an awesome thing. Take advantage of it with me. Here we go. So today we're going to talk about DSTs and transitioning into a diversified passive portfolio. And before we get into that, AOA, we've been around for over 40 years. Many of you, you're members. And I'm just so thankful for you because you guys you're the best and you refer your friends. And so it's just even interesting, just less than 24 hours ago, I think Beth P, she left a review for us and it says, I joined AOA earlier this year at the suggestion of a fellow housing provider. I have found them to be very helpful and it's well worth the annual dues. I've already referred others to them. And so that, we just thank you, Beth, by the way. Thank you so much. And that's really how I think we've become the largest individually organized groups of apartment owners here in the state. And we are dedicated to your real estate success. And there's a time for everything, a season for everything. Some of you are in the season of transitioning to a more passive approach to your management, and others of you are really just still in the thick of it. And so that's where the DST might become the DST might become interesting for some of you. And I don't know if you guys missed it. Last week, there was some news about a couple different cases from New York City where they were just, wanting to push back against rent control, went all the way to the Supreme Court, and they declined to take those. But we did on Tuesday have a live stream with a property rights expert and takings expert that is in New York City. And he's with Pacific Legal Foundation. I just want to encourage you to go back and watch that one. Go to AOA USA on YouTube and you'll be able to find that. And then there's a bunch of stuff that you may have missed that one. You can still catch it. There's some other things that are coming up here, in-person events. And March 14th, we do have an in-person event. It's conflict resolution for housing providers. That's going to be in San Diego. So if you're in the area on March 14th in San Diego, we'd love to see you there. March 26th in Fremont, we have a 12 pillars of property management. And then March 28th in Oakland, we have a doubleheader. One is understanding the eviction process. And then the other one is about asset protection. And so those things are coming up. It's free for you if you're a member. Again, membership, it's $97. There's no per unit fee. There's no additional fee for users. So you have unlimited users with that. And then also the one that I didn't mention was the AOA $1 Million Trade Show and Landlording Conference at the LA Convention Center. And we definitely have over 150 different vendors that will be a part of that. So you'll meet a lot of professionals that can help you with your managing your property, doing what you need to do to it. And if you're not a member, you get a free 6-month membership if you've never ever been a member. And so those of you, bring your friends, tell them to come out. And of course, we're going to have over 20 different seminars. And I believe our speaker today, or at least his company, I believe they're going to be speaking there as well. And then another one that I wanted to mention, I know a lot of you in Northern California are aware of it. San Francisco Chronicle has a little search engine that they put out where you can type in a property address and it will pull up the name and the residential address of that owner. And so it's public record that you own your property, but they've kind of taken it to another level. And so for those of you that are interested in learning how to get your name off of that kind of a list, you'll want to come because there'll be somebody talking about land trusts at 11 o'clock. So all those things, so many different things going on, so many different angles, and so much that we could talk about, but we have a live stream to do here. So we'll get to it. Our sponsor today is Petra Capital, and they're independent, they're national, They have a combined total of over 100 years of experience. They do about 10 billion in property value. And I think maybe that's you'll have to tell us more about that. But their mandate is really clear. It's preserve capital and protect income. Preserve capital, protect income. So that is their mantra. They're going for it. And then they also do have a proprietary data technology model that to help you customize your portfolio, and that's really cool. Some of you may have seen that in past live streams that they've done. And today there is we have a panel of 3 DST experts that are going to be speaking, but we'll lead off with the founder and managing partner of Petra Capital Properties. He has over 35 years of experience in investment real estate. And so, Brad, wow, it's great to have you with us today.
Well, thanks, Jeff, and thanks for the kind introduction. And I can't tell you how fortunate and blessed we are to partner with you and AOA, and we really appreciate the work you do for the organization and the passion you have for helping investors finish life well, as is our passion as well. So we'll talk a little bit more about that today. I must, full disclosure, I'm a little under the weather. So I'm going to be passing the baton off here to my colleagues sooner than later in the process. But I just want to make a few opening comments and maybe give a little bit of background on Petra and kind of how we're different. I think a lot of your listeners on this podcast today have all been exposed to DST, Delaware Statutory Trust, and understand the basic value proposition behind diversified property ownership that you can gain through a Delaware Statutory Trust structure. So the what of a DST is probably not as much the issue today that we're going to talk about as much as why. Why do you need DSTs in your portfolio? And ultimately, how does Petra do it differently? And I think that's the real key today, is to talk about why DSTs, but also why is Petra different? What do we do different than other advisors in the industry? And I think that's an important distinction that we need to draw out today, because we do take a much more of an investment planning approach to the way we put our DST portfolios together from a diversification and asset allocation standpoint. Maybe just a couple opening comments. Well, first of all, let me introduce Luke Lofman, who's our president and chief investment officer. Luke has been with me now for 6 years, but we've known each other from former associations and businesses for probably the last 15 years, and just a very gifted person and very humble person to go with it, which sometimes those two things aren't always synonymous. So Luke's with us today. And then Michael Chabot is one of our managing directors, and he works with a lot of our California real estate investors. So Michael Chabot and Luke Lofman are joining me on this call, and thanks, guys, for participating today with me. I think as a veteran of real estate for almost 40 years now, I've got scars that no man can see, as Jeff and I've talked about, and I've been through about 4 or 5 recessions and 8, maybe 10 corrections, real estate corrections in my career. And I can tell you, in the words of Warren Buffett, one of the most legendary and most successful investors of all time, he has a great quote, and he says, "It's great to learn from experience, but preferably somebody else's." And I think there's a lot to be said about that when you're dealing with a company like Petra with over 100 years of real estate investment experience in all aspects of acquisitions, development, operations, financing, capital markets, you name it. We've been involved in just about every facet of real estate ownership, from acquisition all the way to disposition. And I think it's super important that investors know what they're investing in when they buy a piece of real estate, but equally as important is who you're investing with. I think you have to get both of those right, what you're investing in and who you're investing with. So for Petra, our focus is on helping landlords like yourselves on this call find an option, find an exit ramp if you're looking for that, to retire from being an active landlord and the day-to-day property management. I don't need to tell any of you on this call how challenging it has been, and it continues to be in this environment with more regulatory, governmental, legislative controls that are being imposed on landlords today. As I've heard one economist call it, the axis of upheaval. We're living in the axis of upheaval. And that's where social, political, and economic unrest all collide at the same time. And I think that pretty well describes where we are in the world, where we are in this US economy, and ultimately breaking it down to your local markets. You've got a lot of pressure coming at you today from the governmental regulatory requirements, but also that's from the top down. I also hear from you all every day because we work with landlords all over the country, particularly in California, and the challenges that you're facing economically on top of the legislative changes. Your property taxes are going up astronomically. Your insurance is going up astronomically. So at the very same time, you're getting more regulatory requirements coming from the top down, you're getting squeezed in your profitability from the bottom up. And so you've got this convergence of factors that's making it tougher and tougher and tougher to be a landlord. And so for many of you, you're looking at this decision of, do I hold or do I sell? And Michael, I'm going to turn it back to you at maybe just a little Q&A between us, because you do talk to a lot of these investors every day. What are you hearing? I've just given kind of the macro review of kind of what the landscape looks like. What do you see and what do you hear? Oh, you're muted, Michael. Michael, you're muted. You're muted.
It won't let him talk, it sounds like.
Huh. Well, guess we're going to have a monologue here. Michael, any ideas, Jeff?
Okay, they unmuted me. Sorry, guys.
There you go. There you go.
It wouldn't allow me to turn off mute. I apologize.
And we're horrible lip readers. So go ahead.
Yeah, I'm not good at pantomime, sorry, or sign language.
So, Michael, what are you seeing out there before we jump into our Petra difference?
Well, yeah, and I mean, Brad, my background is I've been in real estate, and especially on the finance side of it, outside of my role with Petra. And most of my clients and investors that I deal with in California, they're concerned about all the things that you talked about. They're concerned about, the insurance crisis. We're seeing insurance costs across the board go up. HOA dues for people are going up. And I know this doesn't relate specifically sometimes to property owners, but these are just some of the things that we're seeing, right? And the insurance, it's a big deal. We're seeing in some cases insurance costs going up 200, 300% because they're in fire areas or they've had multiple claims, stuff like that. And I know, Jeff, we talked about that before we got on the call here. The restrictions, Brad, we talked about, there's the squatters' rights that's happening right now. That's a big thing too that I would love for you to elaborate on. I think that's important. We're seeing, property taxes continue to go up, and it's the biggest concern for my clients that are investors and own investment property owners are the cost of doing business, the cost of providing housing, and then on top of it, all of the regulations that are put on top of them at the state level in California. And it's making it really difficult to continue to be a property owner and a housing provider. That's really what we're seeing. It's like we talk about a lot. Landlord rights are diminishing in California. And so DSTs are a great opportunity for people to trade being in a state that has so much control and is so, I hate to use the word anti-landlord, and move their investments into other states that are much more landlord friendly, which makes a lot of sense.
Yeah, it's tougher and tougher, as I said earlier, to be a landlord in this environment, and a lot of our investors. I'm always intrigued when we talk to our investors about, when I ask them, what are you really making? What's your return on investment on your property? And when we really do the calculus, when they do the calculus and look at their cost basis of the property, not their appreciated value, which is what they can defer through a 1031. But when you look at the actual cost basis and you take all of your rents less all of your operating expenses, including your CapEx and your repairs and maintenance, plus insurance, plus taxes, plus interest expense if you have debt, And when you break it all down and you get down to the true cash flow of the property, we're looking at most cases at less than 2% cash on cash returns. That's historically what we see across the board for individual landlords. And so when you consider the cost of ownership and the risk of ownership growing to be an individual landlord, given the choice, if you can diversify out of active day-to-day property management and invest in a portfolio of passive income producing properties that are much higher quality, that are third-party managed, and you can actually get a raise out of that transition, going from maybe a 2 to 3% return to maybe a 5 to 6% return, what's not to love? And so I think the real crux and the inflection point now for investors is, do I hold or do I sell? And it's easy to make the sell decision. It may take you a little longer to sell in this environment because of some of the headwinds facing real estate, particularly interest rates and the cost of ownership and what it costs to finance a property today. So all cash buyers, of course, have a lot more clout in this market, right? So when sellers go to sell, they will get out. They will eventually sell. And that's not the hard part. The hard part is saying, what will I buy? What will I be replacing this property with? And what are my options? What are my choices? And that's where I think the difference maker for Petra is, we aren't just going to replace a property for a property. We're going to replace a property for a portfolio. It's as if when you're a stock investor or bonds, any other financial assets, you're not going to own a stock particularly. You may like one or two, but generally speaking, most of us get our exposure in the stock market through an index fund, passive index fund. And if I liken what Petra is doing to an index fund, that's really the connection point where investors can say, yeah, why would I just want to buy a property or two to replace what I just got out of? If I could own a portfolio of self-storage, Amazon, medical facilities, Tractor Supply, Walmart, Home Depot, if I can own a spectrum of real estate at much higher quality government properties with a government guaranteed lease behind it, if I'm collecting rents from those types of tenants, I finally will have what I call SWAN income. You know what the SWAN stands for, Michael? Sleep well at night. How many investors on this call would like to have SWAN income? I mean, I can see you all raising your hands right now. So with that in mind, I want to show you all on this call, Jeff referenced it earlier, Petra has taken 100 years of combined real estate investment advisory experience, 100 years, and we've combined it with a proprietary financial technology model that underwrites and scores and evaluates every DST in the market with a quality rating. And then when an investor comes to us, we take that hybrid model of advisory experience with our technology tools, and we build customized and personalized portfolios for our clients that are directly suited, exactly tailored for the investor's risk tolerance, cash flow needs, and liquidity requirements. We customize and personalize every portfolio to match the investor's suitability. It's almost as if it's a mutual fund approach to 1031 investing. It's a very unique and different experience. And we've got investors from Maine to Hawaii who look at our program and say, where have you been all my life? I never knew this option existed. So with that in mind, Luke, I'm going to turn it over to you and let you kind of work the magic for a few minutes and show folks how we can build a portfolio.
All right. Thanks, Brad. So hopefully everybody can see my screen now. This kind of gives you a glimpse into what we get to do every single day. When we work with the client, we open up access to a large database that we've created of all these different DSTs and can showcase what is on the market at the moment at that particular date and time, and talk about some other assets that may be coming to the market, review lots of different aspects of each different asset class, and discuss the pros and cons of these properties. But to kind of get an idea of where does this information come from, well, we have a massive database that we've inserted a ton of information from the markets on different properties, on these sponsoring companies that actually create and own these assets and syndicate them out as 1031 exchange eligible investments. And this platform is kind of like a front end interface. These are all sample properties that you're seeing here. So these are not properties that are currently on the market. However, we have a handful of sample properties that kind of represent what is available. And to kind of give you an idea, when we look at these properties, we're not just looking at some basic aspects of these assets and figuring out, hey, this looks like a good property. We're going through underwriting. That's my background. I've underwritten and acquired and developed ground up historical renovations of many different properties across the U.S. So we underwrite these properties and look at the unit economics of each of these assets. And then we also look at the sponsor quality as well. So these firms that are structuring these properties together, we want to make sure that we're understanding who's behind the deals, what do their personal financials look like, what's their track record and history. Albeit track record isn't a performance of future results, but it is something that we can take a look at. Are they deviating from a space that they know well? And so we assign all of these different qualitative and quantitative figures to each of these properties. Look at the structure. If there's debt on the property, we try to evaluate which particular assets best fit the needs that we think that our clients are going to want, and then we ultimately add those assets to our platform. So what you're seeing here is a list of sample assets, and I'll kind of scroll through some of these, but you can see like there's industrial, warehousing, line production. We also have assets that are in just the land space. So cash flowing land. We have healthcare properties, self-storage. Typically, these are climate controlled or at least partial climate controlled. Mineral rights also qualifies as 1031 exchange eligible asset. Government lease property, as Brad mentioned. A lot of multifamily. There's probably about 50% of the DST market is represented in the multifamily space. So as I'm sure everyone in California is quite aware, multifamily is quite difficult to underwrite from a property insurance standpoint. Property tax a little easier, but property insurance hasn't really ever been an issue in the last couple years. And about a year and a half ago, that has been one of the most challenging aspects to underwrite on these particular properties. Whereas when we get a quote of what the property insurance premium is going to be, it could very well be 150% higher the following year. So it definitely, it comes up where we've X'd off a whole bunch of different properties in the multifamily space, and it's largely due to location, where insurance providers have pulled out of the market and premiums have skyrocketed. So that's something to keep in mind in that particular space. Other single tenant net lease properties, you can see Dollar General's, Tractor Supplies, Walgreens, CVS's, handful of those types of assets as well, and some more industrial. So when we open up this platform to an investor, what we're typically going to do is talk about these assets, and then we can start to put together a portfolio. So as an example, let's say there's a client of ours has sold a $4 million property, and they paid off $1 million of debt at their disposition. So they have $3 million in proceeds. If they were considering doing an exchange, they have sent that money, the proceeds, to a qualified intermediary, which is necessary because you cannot take constructive receipt of those funds. So you choose a qualified intermediary. The $3 million sales proceeds is sent to the QI. And as part of an exchange, you now need to go out and replace effectively $4 million of asset value. So you're going to utilize your $3 million of equity proceeds, and then you're also going to need to structure in $1 million of debt. Otherwise, if you don't structure in that $1 million of debt, you're going to have to pay what's called mortgage boot. So we can talk about these assets here and look at how they're structured and capitalized. You can see some of these properties are all cash acquisitions, and this is representative of what's on the market. Some of them also have debt. Typically in the DST space, the properties that are capitalized with some debt, they're typically low levered. So we're looking at 50% leverage or less. And you can see in this particular case with the government property, it's about 20% leverage. So in the DST space, that goal of capital preservation and consistency of income comes into play to where not outreaching on the debt side for potential yield, but still allowing some debt into the portfolio may be completely necessary if you have debt to replace, or we could structure an all cash portfolio. Debt's not really accretive in the current market, so to include debt may actually hurt your projected returns. So if we can avoid it, we like to avoid it, but there are a handful of solutions that we can address during this process. So in that example, I mentioned about the $4 million sale, replacing $3 million of equity. We could go through here, open up different properties, talk about the specifics, and start adding them to a portfolio and building out different scenarios. And through that process, we come to a quick summary of what that portfolio may look like. In this particular example, I selected 9 different asset class, 9 different properties, and this represents a handful of different asset classes. Also investments across multiple different states. And typically we're working with multiple different sponsors. So Petra, thankfully, is not captive to any one sponsoring company. And we have the flexibility in that case to review different properties and from different sponsoring companies. There's about 60 or so sponsoring firms in the space. And I think historically we've worked with about 31 or 32 of them. So when we go through this process, we're not beholden to working with a particular sponsor, and we have the flexibility to pick and choose which assets we think are the best fit. So in this particular example, we can get to a projected cash flow up here at the top. Let's see year 1 through 5. And this would be an actual annual cash flow that is projected for this selection of assets. So a 5.18% cash on cash yield for that $3 million investment, of which we're replacing just slightly over $1 million of debt to hit that $4 million replacement value. So overall leverage is pretty low at 25%, and we're earning about $155,000 on an annual basis for year 1. With this particular structure, we can then start printing out these reports and evaluating which different scenarios may be the best fit. So in this particular example, we show the summary here. The down leg is also a kind of synonymous with the property that you sold or your relinquished property, but it summarizes the relinquished property information, the tax deferral that you're benefiting by going through an exchange, and then also what does the replacement property acquisition summary look like? You're buying $3 million of assets, we're assuming a little over $1 million of debt and $4 million in total property value. You see your projected cash flow, some other information, and then we break out in a little bit more detail each of these particular assets, the projected cash flow that comes from the different properties that were selected, and we can modify this and customize it to meet any particular need from somebody going through an exchange, whether that be replacing a significant amount of debt, acquiring all cash properties, and there's some other interesting solutions that we've solved for in here. But as we go through this process, we can look at the consolidated cash flows, which is this kind of a helpful page to look at when we're evaluating different portfolios. But this breaks down the projected income from each of the assets. And as we're looking at how do we allocate capital across this portfolio, we can start making slight tweaks here or pulling assets in and out of this portfolio and adjusting the overall pie chart that you see out here on the right-hand side that includes the breakdown of different asset classes that you've incorporated into your portfolio. So when we go through this process and build a portfolio, typically what comes up is, well, where do I even start in terms of the allocation? What's the right structure, right percentage to allocate to different asset classes? So part of that conversation, it really boils down to the risk tolerances and overall investment objectives for each individual going through this process. If we're looking at a conservative portfolio, somebody who wants a really consistent stream of income, but not much growth potential, we're probably going to over allocate to assets in the net lease space. So long-term contractual net leases, typically really good quality credit tenants, ideally triple net lease properties as well. We can spread out that diversification across sponsorship and across geography, and then build that portfolio that has an overweighting to net lease properties. And then we can structure in a allocation sleeve into some more growth-oriented assets. And those would consist of, say, multifamily, self-storage, maybe a little bit of hospitality, mineral rights, and assets that can reprice quicker with market economic changes. So you can think about a hotel, for example. A hotel reprices their rent on a nightly basis. So every single night that rent has been adjusted, and they can better fluctuate with market demand and pressures. That means they can go up pretty quickly, but they can also come down. So it's something to keep in mind as we're building a portfolio. What asset classes are going to make the most sense for you and your family? This last page also consolidates the projections, the pro forma up here at the top, and then gives you a handful of metrics down here at the bottom that helps evaluate whether or not this may be the right portfolio for you. We have 5-year projected averages. We look at the debt service coverage ratio. Typically, it's a very healthy debt service coverage ratio on these assets if there's, like in this case, there's a minimal amount of debt. But when we get to this final page, we're typically building out a handful of different scenarios with a client, and we're making modifications and tweaks. Sometimes prior to the property sale, we're going through this process, and then sometimes we get a call, on day 44 saying, hey, my property just fell through. I don't have any other options on the table. What should I be looking at, because I cannot pay these taxes? So we call those 911 1031s, and those can be quite challenging to structure in here, but we've done it a handful of times. Ideally, we're working with the client prior to their property sale, or evaluating what their choices may be during those 45 days, so they have some options that they can consider, and build out the most well-rounded portfolio with as much information as we can give them during that interim. But this is available to all of our clients. This is a proprietary software that we open up, and in that case, we would share all the different properties that are available in the current market, and help you make the best decision.
Luke, this is incredible. And again, we do this every day, all day for our clients. And so, again, you've really perfected a formula that I think investors, it would take investors, first of all, they'd never be able to do this on their own because they don't have the technology tools that we built out. It's taken years to build out. But secondly, just the access to knowing all these sponsors and having the history of their performance and their underwriting of each asset and their track record in terms of full cycle events, and how they've done not only on acquiring properties, but how have they done on dispositions. Because I think the late Will Rogers used to say, you don't have a return on capital till you have a return of capital. So just for everybody on this call, just so you know, yes, it's easy to look at cash flows and projected income on these DSTs because they do tend to be much more safe and secure and reliable income streams because of the quality of the real estate and the quality of the sponsorship. But I do think it's important there's also the upside potential for capital appreciation. These numbers on this screen that Luke just talked about are strictly cash on cash returns. This is your current passive monthly income, annual income that's divided by 12, so it pays out monthly. And again, you can see how well diversified it is. It is almost like a mutual fund of real estate with a 1031 tax deferral wrapper around it. So it's a highly unique and diversified structure and allows you as the client to asset allocate however you want along the risk profile that you determine is right for you. As Luke said, you can go into all triple net lease assets, probably limited growth, but you can have that sleep well at night income knowing that Amazon and the government are paying your rents. If you want more growth, you're going to want to move into self-storage, hotels, limited service hotels, multifamily, Class A, all Class A, where you've got more pricing power in your rents. So we call it an anchor and a buoy strategy. You want the anchor to be your fixed income component, your bond-like component of your real estate portfolio. We call that the anchor. You want the buoy, thinking in nautical terms, to be the growth aspect of your portfolio to help you compensate for future inflation. So you want downside deflationary risk, which is your anchor. That's going to carry you through a recession. And then you want your upside inflationary protection through growth in the rents. So we call it an anchor and a buoy strategy. And this is what we do for our clients every day. And I'm happy to say we've got clients, over 400, 500 clients now from Maine to Hawaii. And the only regret they have about anything that they've ever said about their real estate is that they wish they'd have met Petra 10 years sooner, so they could have gotten started on this passive income journey. So we're pleased to have helped so many people. We'd love to help folks out on this call. Jeff, I'm going to turn it back to you and let you open it up to Q&A.
Maybe on mute, Jeff.
There we go. Okay. The host is controlling the meeting. There we go. So thank you so much for that presentation. And yeah, so if you have a question, put it in. If you are watching from the AOAUSA.com website, there's a blue help button at the bottom. You can put your question in there. We do have a couple questions already, so we will get into those. And here we have Allison. Does one assume the same amount of debt in the investment as had in property value?
The IRS rules are that you must go even or up on your exchange values. So whatever debt you carried over from the relinquished property that was paid off at closing, that debt amount has to be assumed in the new property purchase. We can increase the leverage. Again, this is all non-recourse fixed rate debt that goes into these DSTs. So you're getting rid of the personal liability of the debt when you transfer into a DST, which is a huge benefit for older investors, I might add. But it's also fixed rate debt, and it's well below market pricing because our DST sponsors are large REIT type companies, big institutional real estate investment firms, and they borrow cheaper than anybody on this call can probably go out and borrow locally today at their bank. So we're getting below market interest rates at fixed rates with non-recourse debt. In that context, it might make sense to add more debt if you want to benefit from maybe some additional positive leverage down the road when the asset sells. You may get a little bit more growth out of it by putting some more debt on it. The other thing you get is more write-offs, more depreciation and interest expense write-offs. So as long as you replace what you had, you're good. If you want to increase your debt using this DST debt, which is again below market rates and terms, I think it makes sense to add a little bit more debt.
Great, thank you. And then from the web, Ron, approximately how many properties do you have available right now?
Well, Luke, I'll let our portfolio analyst talk about that. What do we got, Luke? You're muted as well.
He's got to pull it up and count them, I guess. Huh?
Yeah, it's probably 2.5 to 3 billion of real estate.
Well, 65 properties at the moment. I'm not sure the total value, but it's 65 different properties. That represents the energy real estate sector, essential service assets, government leased properties, hospitality, industrial, land that is expected to be developed, medical office, 23 different multifamily properties, office, retail, self-storage, senior living, and then a few different offerings that have various assets included in there. So that's a pretty healthy list. That's a lot to choose from. It's a lot to go through and evaluate, but there's a wide variety of options available.
Mm-hmm. Now, some people are like multifamily all the way. Can they put together a portfolio for themselves that's just multifamily if they didn't want to do any of the other types?
Absolutely. There's a client we've worked with who has a very long history in the multifamily space, knows it inside and out. So when we looked at building a portfolio for him, initially off the bat, we wanted to diversify him outside of multifamily. He was insistent he wants to stay in the space that he knows and understands, which I completely understand. Mm-hmm. And so we built out a portfolio with him that was largely, it did have a little sliver in there that was outside of the multifamily space, but it was largely multifamily allocations. And he underwrote every property himself, evaluated those properties alongside us. So that was a fun process to go through.
Cool. All right. Yeah. So Michael here on YouTube, is there a minimum investment amount? Your example used a $4 million deal. How about a 1.5 million sale with 500,000 in debt?
Yeah, good question. There is a minimum investment amount. Typically, it's $100,000. So that would allow you, Michael, if you wanted to sell your property, $1.5 million, you had roughly $500,000 of debt. With $1 million of equity proceeds, you could technically diversify into 10 different offerings. So that would probably be a little bit more diversification. Sometimes we call that diversification, but that is something that you could do. We would probably end up recommending somewhere around 4 to 6 different investments as part of your $1 million portfolio.
Great. I thought that was kind of funny. The 911 1031, that was pretty clever.
They can be quite challenging.
No taxpayer left behind. That's our motto, Jeff. And we have not lost a patient yet. And we have ID'd all the way up to midnight of day 45 and with clients, and never lost an investor as a taxpayer. So we prefer to have a little more planning in advance. And we can, but the beauty of DSTs is they're pre-structured cash flowing solutions that can be assembled like Legos or building blocks to match any capital account, any risk tolerance, and any yield requirements with liquidity features built in. I think it's a big, important issue for a lot of investors. I understand I can get into a DST and collect that monthly cash flow, and all that passive income is great. And I can diversify away a lot of risk because I own multiple property types in multiple geographies. But what if I need my liquidity? And so we're very intentional about building liquidity features into our DST portfolios that allow clients to have access to their capital at earlier stages in the process. And I think it's real important that people understand DSTs are not a cash trap. There are ways to get out of these DSTs earlier in the process.
Mm-hmm. And on the opposite side of the cash trap, let's say someone just has cash and they would like to invest. You'd mentioned minimum is 100,000. Does someone have to sell a property to get into this, or can they get in without a sale?
Every now and then we'll have an investor that just wants to provide some diversification to their overall portfolio. Say they're too overweighted in stocks and bonds and they want to pull a little bit out of that space and put into real estate. So you can do a regular cash investment in these assets. The interesting component with that is by investing in a DST is structured very differently than a private equity deal. Private equity, it's probably beyond this call, but there's the sponsoring company may take a large amount of the proceeds when you end up selling. That can't happen in the DST space. So you get kind of two different benefits. You get all of the upside, your pari passu ownership interest when the property is sold eventually. So if you own 1% of the asset and the property sells, you get 1% of the net sales proceeds. And then on top of that, if you wanted to at that point in time, you could then now start doing a 1031 exchange going forward. So you can, if you have a significant increase in property value, now you can continue to kick the can down the road and defer capital and invest in other real estate, whether it be your own property or another DST.
Awesome. All right.
Yeah, you can start with after-tax money and come out pre-tax if you want to put cash in. So you can start your chain of title on tax deferral using a cash investment.
All right. Well, thank you guys so much for sharing with your expertise with us. We appreciate you. We'll see you at the AOA $1 Million Trade Show at the LA Convention Center.
Look forward
to it. It's always nice to see you there. And we do have another live stream today at 12. And so if you are interested in habitability, it's an attorney from the LA area. So it's probably, I know California Business Code or Building Code is California Building Code. It'll probably have we'll see if it has a twist of LA on it or if it's good for the whole state, but that's coming up. So you guys can check that one out either at 12 or always after the fact on the YouTube channel, AOA USA. That's the YouTube channel. Just search that and the channel will come up and you'll see a lot of different videos. And again, we're here for you. We're in your corner. Lots of different services that we're providing. And so use the tenant screening. Give us a call if you need property management advice. Use the forms. And anyway, we're dedicated to your real estate success. We want to see you be part of the most successful groups of apartment owners here in the state. And anyway, take care, everyone. Thanks again, guys.
Thanks, Jeff.
Thanks, Jeff.
Thanks, Jeff.
Thank you.
Have a good one.
Bye-bye.